Welcome to the daily update, where I'll go over the action in the market for Monday, February 26th, and then we'll see how things look for Tuesday, February 27th. Had a bit of a down day. It was a real yawner. We opened flat, stayed flat for quite a while. Now, you could look at that in a positive way in that we didn't see a real increase in selling. Of course, we saw more of a contraction of buyers. And after setting an all-time high, you would think people making their decisions over the weekend, they would come in, see that we set an all-time high with the S&P and want to jump in, since a lot of folks tend to react to what's already happened. We didn't see that in Monday's session. We're still remaining positive for right now when we look at all of our technicals, but we have some significant overhead resistance above current prices. We're dealing with a period of historical weak seasonality, and you have folks that are pretty much convinced that we're going to go down, which that's quite often when the market will throw a curveball into the whole situation. We're also dealing with extreme positive sentiment, and when we get over exuberant at any given time, we tend to look at that in a contrarian manner. So let's go back and talk about what happened. At the open, we had a flat open, and then prices stayed flat right after the open. We didn't see the usual gyration that occurs for the first hour to hour and a half after the market opens. As the day went on, prices then drifted down. We did find some support at S1 at 5,076, and we just kind of trailed along S1 for a while. And then going into the close, we did end up dropping below S1. So we were down 0.38% on below average volume. This is one of the few days recently that we've seen where we had a down day and volume was actually below average. There's a real wait and see attitude right now that prevailed in Monday's session because a lot of economic reports are going to be coming out later in the week. And so you probably had folks not really wanting to make a lot of decisions ahead of that. Our technicals are still positive for right now. We are looking a little extreme, but we've worn off a lot of those extreme positive readings that we've been getting. We're still looking good on a trending basis. And when you look at price in the S&P, yeah, we're just coming off setting an all-time high. That's all positive. But there's other things that we want to look at under the surface that are giving us a little bit of concern. Later on in the week, it'll be about inflation and interest rates as we get the core PCE inflation report coming out. That's the one that the Fed really pays attention to. And so the market's going to be really paying attention to that. As far as what happened in Monday's session, believe it or not, the small caps actually outperformed. Now, they didn't do great, but they did better than the rest of the market. On a short-term basis, we still have the CCI based on 14 periods and the other one based on 20 periods that's looking extreme positive, and our stochastics chart. The Erin indicator did decline a little bit, but it's still extreme. Keeping an eye on our oscillators. They're kind of confused right now as we're chopping around. The Sean trend meter did decline a little bit, but it's still extreme positive. The boom indicator is still showing that we're kind of far away from that 50-period moving average. And then our 10-period new high, new low study based on the S&P. Long term, we're still looking extreme positive with our 150 and 200-period simple moving averages. We're still dealing with the same basic scenario that the Fed is likely done raising rates. Now, this could all change. If we start to see the economic reports coming in stronger than expected, that could really shift everything over to a much more negative climate because the Fed may have to come in and actually consider raising rates. We're not seeing that necessarily yet. We just want to be aware of that. And if we start to see a trend of stronger than expected economic reports, then we will start to get concerned about that. Right now, the big variable in this whole equation is that it's likely that the Fed will be cutting rates. We just don't know when at this time. The dollar was up and interest rates were up. We ended up closing at 4.3% for the 10-year yield. That put some pressure on stocks. We still have the yield curves that we follow that remain inverted. Sentiment is still extreme positive. We ticked down from 78. We ended up being at 76, but we're still above that 75 level. And when we get to a real excessive reading like we're at right now, the party looks to be going a little too wild and we may want to leave. So we look at using this as a contrarian indicator. But our trend is still positive. The green line's on top, even though it did decline. We're still seeing a weakening trend. The ADX is just not able to get back above its moving averages, either in the short term or intermediate term chart. The bias is negative with the down day, and I'm keeping our momentum at positive for right now, just because we didn't really see much of a decline in Monday's session. We had new home sales that came out. They were up 1.5% on a month-over-month basis. When you project that out on an annual rate, that's 661,000 units, less than the 690,000 units that they thought were going to come out. Last time we had 651,000 units. On a year-over-year basis, new home sales are going up 1.8%. And I don't have a chart to show you of this. Looking at this, and it may be a little bit blurry, I was trying to fiddle around with this chart and blow up this table here to kind of make it a little easier to read. And believe it, this is about as good as I could get. And this is put out by Carson, and there's a typo up here. It says large gains and all-time highs are rare. This is one thing that they've projected going forward. When we set new all-time highs with the S&P, you would think, okay, one all-time high is going to lead to another all-time high, and we're just going to skyrocket going to the moon from here. That's not necessarily what their research shows. And I tried to blow up down here. Looking 1 month out, they're up 56.5% of the time. 3 months out, it's a little better. The further out you look, the better it looks. But we're not seeing 100% positive returns going forward. So just because we're setting all-time highs doesn't necessarily mean everything's going to keep going in that direction. Also, we're looking at the legal insider transactions ratio. We tend to look at this once a week. It is going back up, but not necessarily giving us a real extreme reading right now. And then we're looking at a ratio based on the trailing PE ratios between the small caps and the large caps. When this is going down, that just means the PE ratio is underperforming. And so you could try to read into this that small caps are cheap when compared to large caps, and they're getting at kind of a low reading right now, and it's starting to go back up. Maybe this will help give some support to the small caps. Then we are going to get the ISM manufacturing in Friday's session. So they posted a chart here. That's the dark blue line where we are seeing some improvement, but we're still under 50 when we look at this. And then they shift forward the new orders. And a lot of times these tend to go in the same general direction. We are seeing an improvement in the new orders, so possibly we will see an improvement with the ISM manufacturing. This is kind of interesting, and this is supposed to be a humorous chart. I was just fiddling around going through Twitter, X, whatever it's called these days, and somebody, I don't know who was able to find this out. It's like, who was the first person to ever discover that The Wizard of Oz and Pink Floyd Dark Side of the Moon were connected? You know, the things tend to happen at the same time. This is that same kind of thing where you have in blue, you have NVIDIA, which is just going to the moon these days. And then we have cocoa, believe it or not. And there seems to be a real strong correlated relationship between the two. So if you have found yourself in NVIDIA and in cocoa, you're just having a great year. So good for you. But these markets couldn't be more disconnected from each other, but yet their price charts are actually showing some real congruity here. This is another study that I did go over the weekend, and I just want to keep this in mind. The takeaway from this chart is when the Fed cuts rates quickly, that's usually in response to an emergency situation that is bad and that affects the economy. When they go and start to cut rates and it's more slower and it's based on what's happening economically, but it's not that the economy is falling apart, that tends to be more positive for the market. And here's our intraday chart. Really a yawner of a day. We just had a flat open from Friday's close, drifted down here. Eventually we got down to S1, kind of danced along that for a little bit, and then dropped off a little bit going into the close. Here's our intraday chart. Not an awful lot of change from Friday's session. We actually picked up a little bit of positivity in the pre-market session, and then we just drifted lower. We're also drifting down just a little bit in the initial overnight session for Tuesday. This is one area of concern where we're seeing both growth and value declining, and not a real big concern right now because the blue line and the red line are pretty much right on top of each other, even though they're on different scales. This is a 10-minute intraday chart. We want to see the blue line going up above the red line and actually advancing. This is looking at the growth to value ratio for the S&P. We were positive where growth ended up outperforming, but we're not seeing any gangbuster growth here. What we're going to be watching for is if we see a more decline in prices, is this ratio going to start going down as well? Some end of day charts where growth was down, but down about half as much as value for the large caps. It was up for the mid caps and it was up for the small caps. So we did see a little bit of internal improvement in Monday's session. Here is the small cap growth to value ratio where it's starting to go back up. It really broke out, started to fall back. Now it's going back up. That would be more positive for the market. We're also going back up with the mid caps. That could be more positive as well. We're also coming back up to these previous highs when we look at S&P growth to value. We haven't come back to this previous high, but the fact that we're going up is positive in and of itself. And it's looking like we're getting a golden cross here with this ratio. That could be more positive as well. With discretionary, saw a little bit of an improvement here, but not really breaking out yet. So when I talk about the market holding up so far, this is what I'm referring to. This and the charts that I just went through. Looking at our trend, we are pretty much on top of the moving average, but we're not crossing above it yet. The green line is on top, but it's coming down, but the green line is also above 40, and that's a pretty extreme positive reading. Seeing pretty much that same thing in the short term, where we really haven't crossed above the moving average. The green line's above 40, but declining. So we're positive. It looks like we're in a weakening trending environment, but we're also looking extreme positive at the same time. With volume, we continue to drop off. When we take the last number of days together, here's the chart that we usually look at that's put out over the weekend. When you take a lot of different sentiment gauges together, we're still being extreme positive when we look at that. And that's lining up with what we're seeing in our charts. The Ulcer Index is still showing there's not a lot of fear. We did come down just a little bit with the VIX when we look at the line chart and the bar chart, and we're coming back down into the moving averages. Saw a little bit of a tick up with the volatility of the VIX, but we're still well below the moving averages. And the MACD is rolling over. Now, since about the middle to latter part, I would say the end of November, we've been seeing the VIX gradually start to go higher. It did dip down below its moving average there for a bit, but now we're starting to drop below the moving average again. This would be opposite to a market declining, because when this is going down, that means the VIX is going down, which means stocks are going up. Here's our one-day equity put call ratio. It did go up with the slight down day. This is more negative, though. The 5-period continues to advance. And we're finally dropping down now a little bit with our VIX to S&P 500 correlation. We were getting extreme. We're no longer extreme now, but we've dropped down before only to go back up the next day. So we don't really know if this is topped out yet or not. And other times, and I try to point this out every time, when we get an extreme reading and then finally spike and drop down, that tends to be short to intermediate term negative for the market. We'll be getting a new reading of the Investors Intelligence Sentiment Survey here. Right now, we're still above 3. That's extreme positive, but we could go even higher than this reading. Looking at the advanced decline line, we turned down based on price, but we're still holding up. We never did really break out based on volume, and we saw a bit of a decline there. This is one of the internal measures that we're looking at that is still hanging in there, is we're continuing to set new 52-week highs, and that's really outnumbering the 52-week lows. So our 5-period is going up and our 10-period is going up. So that's positive when you have a lot of stocks inside the S&P making new 52-week highs. Our advanced decline ratio did decline, but it's still above 0. Accumulation distribution did turn down, but it's still above the moving average. The Chaikin money flow turned down a little bit, but it's still positive. The Chaikin oscillator really dropped off here, but it's still above the 0 point. And looking at our advanced decline line studies, we came down slightly with the common stock on the NYSE, the S&P, the mid caps, and the small caps, which are still tending to underperform. Here's our daily chart. We're still above this longer term trend line, which I'll show you later on. At the bottom, you see where volume continues to be below average. We're keeping an eye on the 20-period simple and exponential moving averages. Just in case we break below the trend line, right underneath that would be these 20-period moving averages. So if we really start to fall, we'll be watching to see if this is going to act as support. Here's the CCI 14. Even though it declined, it's still extreme. The CCI 20 also declined, but is still extreme. We did turn down slightly with the 20, 50, and 200 period moving averages. And that's just based on the S&P 500 itself. That's not looking internally. I go over that later on. The Force Index did decline, but we're still above an advancing midpoint. And we're coming down and just barely not extreme positive in the short term with our stochastics. We're still extreme in the intermediate term and in the long term. And we're no longer extreme with the standard deviations chart. We came down just enough to get back into the +2 standard deviations channel. Intermediate term, we did decline with the balance of power, but we're still above the midpoint. We remain positive with the go, no-go system with the darker blue bars. We're still hugging the highest high value and above an advancing midpoint. This is still positive. The TTM squeeze, switching a little bit more negative. We're going from the light shade of blue to the dark blue now. And the 20-period boom indicator is no longer extreme, but the 50-period still is. We're still showing some improvement with the 200. The ease of movement did decline, but it's still above zero. The Arun did decline, but it's still just coming off of an extreme positive reading. We did decline with the S&P McClellan oscillator, but we're still above zero. So we're continuing to go up. Whenever we get a positive answer for the McClellan oscillator, that makes the summation index go up. And so we are turning back up based on price. We're actually going sideways based on volume. It's this longer term negative divergence that we've really been focusing on. When we look at the NYSE McClellan oscillator, we did drop below zero slightly. So it's really hard to see, but we are ticking down just a little bit with the NYSE summation index based on price. We're still continuing to go up based on volume. We did decline with the Swenlin trading oscillator based on price and volume, but we're still above zero. And our PMO, it's trying to turn back up and cross above its moving average. Price is starting to look a little bit more positive, but we're still pretty much flat when we look at volume. So we declined a bit with the PMOs that are rising. We're rolling over a bit with the buy signals, and we're flattening out here with the PMOs that are above zero. We switched from being positive with the Elders Impulse system back over to neutral for the S&P. The parabolic SAR is still positive with the dots underneath. The slope oscillator is right on top of its moving average. The MACD is trying to break out above its moving average, but not quite so yet. So in the short term, we're kind of right on top of the moving averages, looking a little bit better in the intermediate term, where our longer term oscillators are still looking more negative. We're still above all of the plotted moving averages here. And the bullish percent index, this is also rather encouraging. We did see a little bit of an advance here where it went back up, where mostly it's been declining lately, and we're seeing this longer term negative divergence. But at least in Monday's session, it showed a bit of an improvement. We ticked up a little bit with the NYSE bullish percent index, and we also ticked up slightly with the NASDAQ 100 bullish percent index. The money flow is pretty much flat. It's still above 50. The ultimate oscillator did decline, but is also still above 50. The vortex did turn down, but the green line's still on top. We're still looking positive with our RSI based on 14 and 9 periods, where most of the recent prices have been above 50. And we're still looking positive, even though we tick down with the on-balance volume. When we look at our 20-period moving average study, we did decline, and we're keeping an eye on this longer-term negative divergence with those stocks inside the S&P. Also, a bit of a decline with the 200-period moving average study and a negative divergence, and a bit of a decline with the 50-period moving average study and the negative divergence. The Copic curve is still below its moving average, so that's still negative. We did tick down with the Sean trend meter, but we're not really extreme like we were after Friday. Keeping an eye on this, the NASDAQ is really close to its all-time high, but we're wondering, is it going to go ahead and set a new all-time high, or is this previous high going to act as overhead resistance? We did tick down slightly in Monday's session. So we have the S&P just coming off of setting all-time highs. The NASDAQ has not. If this can set an all-time high, that would help confirm what we're seeing across different indexes. With our charts, though, we're still looking good with the Hike and Ashy. That's positive. The Kegi chart is still positive. The Renko chart is positive. And the 3-line break is positive. Long term, we're still above this trend line. If we really start to come down, we'll be seeing, are we going to fall below this trend line? We did that before. And then are we going to close below this trend line? This is the first line of support. Until we break below that, we're still maintaining more of a positive stance. This is kind of the big one that I've been focusing on lately. We're in Friday's session. We came right up to this R1 level. That was the high for Friday, and we have not been able to get back up to it. This is at about the 51.11 level. And just to kind of review this, back in 2021, we came right up to this pivot point, which is good for the whole month. This is a weekly chart. And then we ran into 2022 after that. Then we started to bounce back up. Last July in 2023, we hit another monthly pivot level and then spent the next few months going down. We're coming back up to another pivot point, and so far we've been not able to break through that. Is this going to produce some kind of a turn that we've seen before, or is it just kind of gaining up some strength before it gets set to break on through to the other side? We're still extreme positive with our 150 and 200, even though they did decline. Looking at the different indexes, we're still positive with the Keller market model across all the different indexes. We had some alerts that were triggered, and they were all positive in Monday's session, with Canada still looking pretty good right now. This is another newer ETF that I've been showing. This is a broad market, and this is weighted. I forgot to mention that over the weekend, where the S&P 500 is weighted. And so everybody goes, yeah, the Magnificent Seven, that's why the S&P is going up. And that's true. This is also a weighted ETF, but there's 2,651 stocks in here. And so those 7 magnificent stocks, they're in this ETF as well, but we're still breaking out and setting recent all-time highs with this ETF. And this is just suggesting that, yeah, even though the big companies, the Magnificent Seven, they're doing most of the work at making the market look good, there are other stocks in the market that are also performing well at this time. The equal weight and the S&P were pretty much even with each other. So we came up just a little bit with our ratio. Didn't really change there. The Dow is just coming off, setting an all-time high, but not an awful lot of weakness. The diamonds still remain positive with the Elder's Impulse system. And we were down just slightly with the NASDAQ, and we're wondering, is it going to be able to go back and set a new all-time high? The NASDAQ 100 virtually unchanged, but down just slightly in Monday's session. We still remain positive with the QQQs, with the Elder's Impulse system. We're still negative when we look at momentum for the NASDAQ 100. And this is another one where you've got a lot of the perma bears developing an entire scenario just based on this chart. And they might be right, but they could also be wrong. Where we go all the way back to 2000. When we see this going up, that was the dot-com boom. And what this is measuring is the NASDAQ 100, which is growth, versus the Dow, which are more blue chip or value type companies. And so when the growth stocks are really outperforming, this ratio goes up. We hit a top, and then we saw the dot-com bust after that. It took us a long time. What is this? 16 years, 17 years, something like that. And I can't do the math, to get back up to this previous high again. And we set that right at the end of 2021. Then we fell back in 2022. We finally hit a bottom. Now we're starting to come back up, and we're hitting this previous high again. This may be something really big. It may turn out to be that we break through this and actually set another high in this ratio. We don't have enough evidence right now to suggest that. And that's my concern when folks use one chart to make a blanket, big picture scenario. Is okay, what's some of the other charts telling us? Now, this could ultimately play out and be what they think it will be, but we want to see more confirmation. I'm much more conservative when it comes to that. The small caps were up, but virtually unchanged, held up a little better than the rest of the market. The small caps have actually switched over to positive after being neutral with the Elder's Impulse system. We're still above this support level with the Russell 2000 small caps. The RSI is still above 50. We're in a longer-term uptrend, and we're right on top of the moving average with our momentum. The mid caps ended up being down slightly, but still above this pivot level that's acting as support. They have switched over to neutral for the mid caps when looking at the Elders Impulse system. The FANG index, after setting an all-time high recently, to drop down just a little bit on Monday. The financial sector was down 0.5%, but still continues to be in an uptrend. New York Community Bank was down almost 2.5%. Just keeping an eye on this. And not so much because it's New York Community Bank. We're waiting to see if other shoes are still yet to drop. The dollar ended up being up slightly, and we're still above both of these moving averages. Keeping an eye on the 10-year yield, it was up, where 10-year based on price was down. And then looking at our growth to value ratios, kind of just a bit underneath the moving average. And the moving average is starting to decline when we look at the QQQs and compare to them to the S&P. The discretionary to S&P ratio, as we're chopping along the moving average, we decline, but we're still above the moving average when we compare large cap growth to large cap value. So with the large caps, mid caps, and small caps, we're holding up for right now. We're still positive with our 5-period moving average of the highs minus the lows spread across the broad market. We're also still extreme positive with our 10-day average of the S&P 500 highs minus the lows. We are starting to go back up with our S&P to utilities ratio. That often supports the S&P. So what's our outlook for Tuesday? Right now, we're still positive, and it's holding up for the time being. Now, this could change. We just go with what we see right now. We're slightly overbought. We do have overhead resistance at that monthly pivot level. Weakness is still potentially developing, and we're in a historically weak seasonal time. We will be getting durable goods, the FHFA housing price index, the S&P Case-Shiller home price index, and consumer confidence. We want to keep an eye on the geopolitical events. Lots of crazy things happening all over the world, but it just doesn't seem to be impacting the market. But that could always change. Here's the economic calendar for the upcoming week. In Wednesday's session, we're going to get the second estimate of GDP. If it comes in pretty much the same as the first reading, it'll be a non-event. If it goes way above or way below what we had the first time, that could freak out the markets. The big one's going to be on Thursday with PCE prices. We're also going to get the ISM manufacturing and consumer sentiment on Friday. Seasonally, looking at February 27th, we're neutral to positive with the Dow and S&P. We're flat out positive with the NASDAQ. So from 2002 up to 2022, that has been pretty positive when you look just at February 27th. And we do see a little bit of a bounce sometimes when you look at the Carson chart here, but overall, we tend to see a decline throughout the end of February. This gives you a little bit bigger of a picture where sometimes we see a bit of a bounce in early March before we see some weakness. The gains that we typically get during an election year come after that or later in the year. And we're also thinking that we're coming into this time of weakness here with the Stock Traders Almanac. This also suggests that when the sitting president is running for re-election, that we might still be due for some more weakness going forward. February is still the worst of the 6 best months. Tuesday is one of the more negative days. Not as negative as Wednesday, but it's still in 2023 ended up being down more than it was up. We will be on the 18th trading day of the month where we do see some weakness, according to the Stock Traders Almanac, during an election year for the S&P. Also, Tom Bowley's research suggests that we see weakness going into the end of February. Since we're getting close to March, I ran across a few charts here just to give us a little bit of heads up here. When you go back to 1950 and look at all the election years, we were up 11 times, down 7 times. So we're up a little bit more than down. And the average return for the month of March is 0.4%. Also, looking at the statistics from 1950 to 2023, taking all of the years together, we're up 48 times, we're down 26 times, so we have a 64.9% gain rate going back that period of time, and our average percent increase is 1.1% for the S&P. The scenarios, can't really go with the down one yet. Yeah, you can make a case for that, but what if the market really starts to go up and break above that overhead resistance? That we're not seeing enough evidence for that yet, even though that still could happen. So for right now, the technicals are positive. They're holding up. We're slightly overbought. We do have overhead resistance. Weakness could still be developing, and we're dealing with weak seasonality. That's why, unless we see some strength and an upward move, we would lean towards the positive side, but we would only buy into strength if you wanted to establish new long positions. For right now, we're not dealing with the sideways environment because our ADX is still above 20. The warning signs. Now, other than in Monday's session, typically what has been happening lately is volume has been decreasing as the S&P has been going up. The risk on posture is just not useful right now. The equity put call ratio based on 5 periods is going up. Our oscillators are just kind of really funky right now. And we're seeing some longer term negative divergences. We're also seeing negative divergences with the McClellan oscillators and summation indexes. The Copic curve is negative. The bullish percent index for the NASDAQ is still below 70. And the momentum for the NASDAQ 100 is also weakening. Small and mid caps, when you just take their indexes, they continue to negatively diverge from the S&P. Discretionary is still negatively diverging from the S&P, and the transports are negatively diverging from the Dow and the S&P. Maybe I should create a slide here that just has a negative diverging list on here. And then we are in that seasonal time of weakness, at least historically. The positive signs for right now, growth is holding up. The parabolic SAR is still positive. Our oscillators, even though they're dropping below their moving averages, they're still giving us very high readings. The vortex is positive. Small and mid cap growth is still positive and hanging in there for right now. The financial sector was down, but is still positive. So our conclusion, we're holding up for right now and we're still positive. Now, that could change with a solid down day. We're slightly overbought. We do have overhead resistance. We are seeing some weakness, and we're dealing with this weak seasonality. That's what we're seeing in the short term, because that's where everything starts. Intermediate term, we're still slightly overbought. We're wondering if weakness is going to start developing there, but we still have overhead resistance no matter what time frame you look at. And we're still extreme positive in the long term with our 150 and 200 period moving averages. Thank you. I really hope you found this helpful. I hope you have a great day, and I will talk to you in the next video.